Hello, my name is Yana, and today I want to talk about basics of sales of partnership interests. Prepare for Business Tax Accounting, Chapter 10, Learning Objective 1. Learning objectives in this presentation. What is partnership? Taxes and partnership, sellers issues, outside basis, inside basis, hot assets, and buyers and partnership issues. First, let's remind what is partnership. A partnership is a formal arrangement between two or more parties to manage and operate a business and share its profit. Exist two types of partnership: general partnership and limited liability partnership. Taxes and partnership. There is no federal statute defining partnership, but nevertheless, the Internal Revenue Code includes detailed rule on their federal tax treatment. Partnerships don't pay income taxes. Their tax responsibility passes through to the partners who are not considered employees for tax purposes. Individuals in partnership may receive more favorable tax treatment than if they founded a corporation. That is, corporate profit are taxed as are the dividend paid to owners or shareholders. Partnerships' profits, on the other hand, are not double taxed in this way. First, let's talk about sellers' issues, which appear when partner sells his partnership interest. Many partnership arrangements don't allow the unrestricted sale to the public, and the remaining partners don't want to be forced to accept anyone who may not be desirable for the business, who may not have their requisite skills, or who may not get along with other partners. However, where the sale of a partnership interest is allowable, the interest can be sold in a whole or in the part of at a profit or a loss. Because tax law reviews a partnership both as an entity as an aggregate of partnership, the sale of partnership interest may result either in a capital gain or loss, or a portion of the gain may be taxed as ordinary income. This differs from the sale of the corporate stock, which is viewed as a separate entity from the shareholders, in which the sale results only in capital gain or in loss. Here is the formula how to calculate a capital gain or loss. We have to subtract partnership from the amount of the sale, and this represents also a partnership outside basis. Now let's talk about what is outside and inside basis and what the difference between them. Inside basis. This is the partnership basis in the individual assets. Outside basis represent each part basis in the partnership interest. When a partner contributes property to the partnership basis in the contributed property is equal to its fair market value. The outside basis of the partners increase only by the amount of the basis that the partner had in their property. Now let's look at the example and let's define what is the difference between inside and outside basis. You contribute a land to a partnership with a tax basis of $10,000 and fair market value of $50,000. Your other partner contributes $50,000 cash. Since the fair market value of the land is also $50,000, you each have equal equity in the partnership, and the total inside basis of the partnership is equal to $100,000 you contributed contributions. However, your outside basis differs from your partners, since your outside basis is $10,000, while that of your partners is $50,000. If you sold your partnership interest for $50,000, you would recognize a gain of $40,000, whereas your partner, if they sold of the same price, would recognize no gain. Now let's look at the second example that will show us how to calculate and recognize gain when the partners sell their partnership interest. Let's assume that last year ABC Company sold its interest in CCS on June 30 to Mark Randall. Mark anticipated the CCS company would be profitable and paid to the ABC Company $100,000 for its interest in company. ABC Company's share of the CCC liability as of June 30 was $24,000. ABC Company basis its interest at the sale date was $105,000. including its share of CCC liabilities. What amount of gain or loss did ABC recognize on the sale? First we have to calculate the amount realized, that would equal $124,000. We have to add cash receipt with the debt relief. Then we need to subtract basis, and we come up with recognized gain, which equals $19,000. Now let's talk about hard assets. What are hard assets? Hard assets are business assets that have the potential of building ordinary income. In other words, these are assets that would generate ordinary income if sold. The main two examples are inventory and account receivables. A partnership that has unrealized receivables in inventory that when sold by the partnership causes it to recognize ordinary income complicates the taxation of the selling partner's interest, since some of the gain or loss may be ordinary rather than capital. The selling partner must recognize the income just as if those assets were sold, with the ordinary income being allocated to the partner. This rule prevents the conversion of ordinary income into capital income that is usually taxed at a lower rate from the sale of the partnership interests. Now let's look at the balance sheet. Here we see that account receivable equals $50,000, and this is a hard asset. Then $6,000 depreciation, which is calculated by subtracting $86,000 from minus $80,000, and account receivables are unrealized receivables because the company has not included it in income from tax purposes under cash method. Depreciation is also considered as unrealized receivables. Inventory would be considered as hard assets as well. When partner sells his interest that holds hard assets, modifies his calculation of the gain or loss to ensure that relief to the hard assets is properly characterized as ordinary. The process of determining the gain or loss follows. First, calculate the total gain or loss recognized by subtracting outside basis from amount realized. Second, calculate the partner's share of gain or loss from the hard assets as if partnership sold these assets in the fair market value. This represents the ordinary portion of the gain or loss. And finally, subtract the ordinary portion of the gain or loss in step 1 from the total gain or loss from step 2. This remaining is the capital gain or loss from the sale. Here is the example. Account receivable equals $10,000, and this is a gain, which is defined by subtracting fair market value from their basis. Then we have to multiply it by 30% of the interest share. Equipment gain equals $6,000, then multiplied also by 30%. Total ordinary income equals $48,000. Then we can calculate capital gain, which is calculated by subtracting ordinary income from total gain. Now let's talk about buyers and partnership issues. A new investor in a partnership is of course concerned with determining how much to pay for the partnership interest. However, his primary tax concern about his basis and his share of the inside basis of the partnership asset. In general, for the sale transactions, the new investor's outside basis will be equal to his cost of the partnership interest. To the extent that the investor shares the partnership liability, his share of partnership increases his outside basis. Now let's look at the example. Let's assume that Mark Randall accrued ABC Company 30% interest in CCS Company for $100,000. On June 30, he granted his share of CCA debt just as ABC had done. As a result, Mark will be allocated his share of CCS allocable debt in accordance with his 30% profit sharing ratio. What are the outside basis of Mark's accrued interest? The outside basis will be equal $124,000. In this case, we initial basis have to add to share of CCA's liabilities. The Mark share will equal $105,000. Refer to the balance sheet. Mark's capital gain is equal not gain account is equal $81,000, and the share of liability is equal $24,000. We just need to simply add these two amounts. The sale of partnership interest often results in a difference between the new investors' inside and outside basis, because the outside basis in the price paid based on fair market value, and the inside basis in the seller's share of tax basis of the partnership assets. A partnership experiences very few tax consequences when a partner sells his interest. The sale doesn't affect partnership interest, inside basis, and its assets. The new investor's share of inside basis is equal to the selling partner's share of inside basis and the sale date. In the sale of partnership interest, the selling partner's interest, the selling partner's tax capital account carries over to the new investor. In conclusion, we can conclude that today we talked about partnership. What is this? What are sellers' issues? What is inside basis and outside basis? And what the difference between them? What are hard assets? And buyers and partnership issues. Here are the sources that I used to prepare this presentation, and thank you for the attention.